Right now, a single New Zealander living alone gets $555.15 a week from New Zealand Superannuation. That sounds reasonable on its own, until you compare it to the cost of a basic lifestyle in a main centre like Auckland or Wellington. One widely used estimate puts that figure at around $705 a week. Do the subtraction and you land on a gap of roughly $150. That gap shows up every single week for the rest of your life. This video walks you through how dividend investing can close it. You'll see what size portfolio you'd actually need to build, and you'll see how New Zealand's tax rules can work in your favour, or quietly cost you money depending on how you structure your investments. So, let's get into the numbers. A dividend, put simply, is your slice of a company's profit. You own shares in a business, the business turns a profit, and instead of keeping all of it, the company hands some of that money straight to shareholders in cash. That's the dividend. New Zealand does something with dividends that most countries don't bother with, and it's a big part of why dividend investing works so well here. Companies pay tax at 28% before a cent reaches you, and to stop inland revenue taxing that same money twice, once at the company level and again in your pocket, the system attaches what's called an imputation credit to the payment. Picture it as a receipt proving the tax has already been settled. A fully imputed dividend carries that receipt, which means you generally don't owe anything further, beyond squaring up to your own personal tax rate. What you'll usually see in practice is 5% taken off at source, known as resident withholding tax. And here's where it gets interesting. Add that 5% to the 28% the company already paid, and you land precisely on 33%, matching one of the personal income tax brackets exactly. Sit at or below that 33% rate yourself, and in many cases there's no further tax bill waiting for you at all. But here's the thing, if you're investing through a platform rather than picking individual company shares, a different set of rules kicks in. Funds like Smart Shares, Kernel, or the InvestNow Foundation series fall under something called Portfolio Investment Entities, or PIE funds for short, and instead of taxing your investment income at your personal rate, these funds use what's known as your prescribed investor rate. 4 options exist here: 0%, 10.5%, 17.5%, or 28%, and that 28% figure does double duty. It's both the default rate applied if you never tell the fund otherwise, and the hard ceiling nobody can be pushed above. What nobody expects until they run the numbers is how much that ceiling matters for higher earners. Someone sitting on a personal tax rate of 33 or 39% can genuinely cap their investment tax at 28% simply by choosing a PI fund over direct share ownership, and that's not a loophole, it's just how the structure was built. One quirk worth flagging: the income thresholds used to work out your prescribed investor rate, $14,000, $48,000 and $70,000, haven't shifted since 2010, even as the ordinary tax brackets have moved on since then. So it pays to double-check your rate is still correctly set with your provider. Now, what about investing overseas, say buying United States shares through something like Sharesies or Hatch? That's where the foreign investment fund regime known as FIF takes over. Cross a certain threshold with the total amount you've put into overseas shares, based on what you paid rather than what it's worth today, and inland revenue can tax you on a deemed return each year, currently set at 5% of your portfolio's opening value, regardless of whether those shares actually paid you a cent or went up in value at all. $50,000 was that threshold for years, and from the 1st of April 2026, it's set to climb to $100,000, based on Budget 2026 announcements and how platforms like Sharesies are already treating it. One honest caveat belongs here. Some analysis suggests the legislation confirming that higher threshold may not be fully locked in yet. So if this affects you, it's worth checking Inland Revenue's website directly before you rely on it. There's a workaround too, and it's a good one. Route your overseas investing through a New Zealand-based fund rather than buying the shares directly, and the fund absorbs all that foreign investment fund complexity internally, leaving you taxed under the simpler PIE rules instead. Time to run the actual numbers, because this is what you came here for. That $150 weekly gap works out to a bit over $7,800 a year you'd need to find from somewhere other than New Zealand superannuation. So the real question becomes how much money, sitting in dividend-paying investments, would generate that $7,800 annually. Estimates for the average dividend yield across top companies on the New Zealand Stock Exchange land somewhere between 4.5% and 5% a year, though that figure shifts depending on the source and the year, so treat it as a rough guide rather than gospel. Run the maths at 5% and you'd need roughly $156,000 invested. Drop to 4.5% and that climbs to around $173,000. Somewhere in that range, call it $155,000 to $175,000, sits the amount that could realistically close the gap between New Zealand superannuation and a no-frills retirement, and that's before tax even enters the picture. Thanks to imputation credits, if your total income keeps you at or under that 33% bracket, a large chunk of that dividend income could reach you close to tax-free on top of what the company already paid. Context helps here too. The Retirement Commission has pointed out that around 40% of New Zealanders over 65 have virtually no income beyond New Zealand superannuation, and a further 20% have only a little more than that, which means building even a modest dividend portfolio puts you meaningfully ahead of a huge share of retirees. The backdrop to all of this matters as well. 2.25%, that's where the official cash rate sits right now, after the Reserve Bank of New Zealand spent the past couple of years cutting it steadily downward. Reserve Bank Governor Anna Bremen didn't sugarcoat things at the most recent review, putting it plainly. These are challenging times for New Zealanders. Lower interest rates tend to drag down returns on term deposits and savings accounts, and that's part of why dividend-paying shares become more attractive as a source of income when rates fall. Inflation tells its own story too, sitting at 3.1% at the end of last year, with the Reserve Bank actually forecasting a climb toward 4.3% by September, before easing back down near 2% by the middle of next year. Another official cash rate review lands on the 8th of July, and while most bank economists expect a hold at that meeting, several are picking increases to start from September onward. None of that is settled yet, so if you're watching this months after it was made, it's worth checking the latest figures for yourself. So how do you actually get started? Platforms like Sharesies, InvestNow, Hatch and Kernel all sit under the Financial Markets Authority, the body responsible for licensing investment platforms here in New Zealand, and each charges fees a little differently. Sharesies takes 0.5% a year on balances up to $50,000, capped at $250 annually, and effectively nothing above that threshold, plus a small fee on each transaction. InvestNow runs things differently again, charging no platform fee and no transaction fee at all, leaving you paying only the underlying fund's own management fee, which for some index funds starts from around 0.2% a year. Comparing those fee structures before picking a platform can make a real difference to what you keep over the long run. Here's what it all comes down to. New Zealand superannuation gives you a solid, guaranteed base. But for a lot of people, it likely won't stretch far enough to cover a comfortable lifestyle on its own. And the gap between that base and a no-frills lifestyle looks to be around $150 a week. Closing that gap through dividend investing could realistically take a portfolio somewhere between $155,000 and $175,000, depending on the yield you actually achieve. The way you invest changes the outcome too. PIE funds cap your tax at 28%, no matter how high your income climbs, while directly held New Zealand shares carry imputation credits that can wipe out most or all of your extra tax, provided you're not sitting in the very top brackets. And if you're looking overseas, keep half an eye on the foreign investment fund rules, so nothing catches you by surprise later. Sorted.org.nz remains a genuinely useful free tool if you want to run your own numbers from here. If this video helped you see where you actually stand, hit like, subscribe for more videos breaking down New Zealand investing, and turn on notifications so you don't miss what comes next.